All right, here we are with another market update. Today we are coming off a great weekend, Ryder Cup weekend, where the US showed some face, tried to make it happen, ultimately came up a little short, but they put out a great effort, and I'm really excited for the next Ryder Cup a couple years from now. We also came up on a heartbreaking tie for our very own James and his Cowboys team. But again, very good effort. At least it ended in a tie. What do you
Former
think, Griff?
former Dallas fan,
Former Dallas fan.
for the
They've
record.
gotten rid of every good player that James likes, and he's on the fence right now.
Yeah, I don't know. It's hard to say. I mean, I think that sometimes a loss is better than a tie. Tie seems pretty bad there. I don't know. Maybe they just ran out of time. But
Maybe. You know what's not running out of time? The market. Here's where we are. Stocks have held up pretty well. Interest rates aren't swinging like crazy. The economy is surprising us to the upside. The big question is, can we carry this momentum into the end of the year, or are we kind of setting ourselves up for a big letdown? So, Griff, any thoughts on that as we kind of start our market discussion today?
yeah. I mean, I think a big question that we're hearing is, is this a top? A lot of folks look at, the market and a chart and say we're at all-time highs. So is this a top? I think really more of the question is, are conditions getting better or are they getting worse? And we'll talk a little bit more about that in the coming slides, but I think that they're improving. I think
Yeah.
if you think of the market like an airplane, you don't need full throttle to climb elevation, but you do need a steady lift. And so as we think about that, there's a lot of things that kind of add to that. So
Great.
yeah, so I think that big picture, our outlook as we expect stocks to continue to trend higher going into year end. Um, we do think there could be, potential pullback here or there. Some There are some risks though longer term. We see nearing leadership, meaning higher concentration in a smaller sector, industry, or list of companies as one. Another being really the high equity percentage in households right now. So we'll show a chart here later on, but households are owning a higher percentage of stocks than they have in a long time. So
Yeah, I think that right now the way that the stock market has worked is that leadership has continued to lead, right? And as we go into our discussion, we'll talk a little bit about the broadening of that trade into different sectors. Uh, but we'll kind of dive into that as we go through some of the decks that we have for you prepared.
all right, we'll start off with global.
Hmm.
I think as we think about global, we're going to show a model here next on the next slide that goes through the global recession model. But there's a number of different indicators out there that give us an idea of when we may be heading into a slowing economy. Right now, we're in a low risk zone. Get that off my tongue there. And I think a couple of things are at our back here. People are feeling really good right now. Sentiment is very positive. In fact, global sentiment has actually lessened the spread between US and global, which I think is a good thing to bring the rest of the economies there with us. And then secondarily, not only is the US Fed cutting rates, but other central banks have done so as well. And that's usually a pretty good sign.
Yeah, so I agree. The global economy as a whole is in pretty decent shape. We've seen some wobbles here and there, but the risk of a full-blown recession has actually kind of gone down. Here in the US, the consumers are spending. It's keeping things afloat for now. China is slowing a little bit, but a lot of that is kind of baked in. Europe is moving slightly, and the UK is struggling with inflation, but overall, it's a mixed bag, but not too bad. Not too bad.
Yeah. I think the biggest thing is one, small rate cut doesn't necessarily solve the problem, but a bunch of central banks all trending and doing similar things,
Yeah,
pushing us into the easing cycle is going to obviously help in a lot of ways.
yeah, I agree.
So here's one of our charts we look at here frequently from Ned Davis. What this shows you on the top is the probability model of the global economy going into a slowdown period. Those gray columns there indicate OECD defined global slowdown periods, and then that line represents what the probability model is at. So um, to be in a recession on the bottom end of that chart is a lower probability, whereas to be in a recession on the top end of that chart is a higher probability. Right now, we are at a 29.8 probability model, which means that we're below 30, and there's a low probability for us to go into a global recession.
Yeah, I always think of the economy in cycles, right? Going back to my econ days for my undergrad, the way I describe it now to clients is think of the global economy as a jogger, right? And the US specifically, it still has little gel packs in their running pouch to kind of keep things going. Eventually, we need to have an injection of energy to kind of keep things going. But for now, we're going along, right? No big risks on the horizon that are triggering this model to kind of sound the alarm. So we're just steadily moving forward as things start growing in the economy, as things start happening globally. We'll keep moving in this direction with this model. But for now, no major recession risk is kind of what we see.
Yeah, and to that point, the easing we've talked about in the previous slide is kind of pushing into this. Easing allows for cheaper borrowing, obviously. A lot of folks up there have variable rate loans and mortgages and things like that. And so when rates drop, monthly payments shrink, and that frees up capital for people like you and I and businesses to spend. Also think about the, incentive to spend versus save. If you might get 5% on your cash, that might be you might feel pretty good about that. But as we get closer to 3 and 2, people stop thinking about putting money in cash and they start thinking about either investing or spending that towards a better ROI.
Yeah, so I mean, I think inherently it makes sense, right? When the Fed cuts rates, it's lowering the cost of borrowing, and businesses and consumers each get a little bit more breathing room in their balance sheets. Other central banks have followed, which creates this rising tide across the globe. Uh, Also, on a side note, surveys have shown that people are feeling better about the economy, and optimism usually turns into spending and investing. So we're kind of seeing this trend to continue growing the economy. Again, we're going back to the last slide. We still have some gel pouches, right, as long distance runners, and we have some ways to inject growth into the economy. One of those ways is by cutting rates, and the Fed has begun to do that recently.
Yeah, so regionally, if you think of it, going back to that plane analogy, you think of it like three-engine plane, if there is such a thing. The big engine here, which is the U.S., which drives a lot of the global economy, is strong. I think that we look at Europe having some modest improvements, and therefore being more of that stable engine. And then some of those emerging markets, like China, uh, they're showing signs of slowing, but it's within expectations. So I think really surprises on the downside are what hurt market prices, and it's not necessarily price to perfection right now. But those are kind of what we're seeing right now as far as regional signals. So a big part of the discussion, I think, revolves around inflation. So the Fed can really cut. I mean, right now the labor market has softened, and so that gave the Fed the ability to come in and cut rates. I think thing we look out for is really inflation. If inflation accelerates to a fast enough pace, then that could leave the Fed in a tough predicament. And so here on that bottom part of the slide, you'll see that the orange line shows the rate or the speed of inflation. And we remember those times during COVID where we had rapidly increasing inflation and everything was going up. And cost, that started to come down a little bit, although we do see some small upticks here and there. And so that's something we're keeping a close eye on. But big key there we need to watch out for is that as as the rates go down, that should boost demand. The demand could also cause inflation. But we also have some supply constraints with tariffs and labor restrictions, and those could also drive up costs. So we have kind of two different forces pushing at potential inflation increases.
Yeah, no, super, super important point there. Even with rate cuts, inflation is still lurking in the background. We've seen some indicators slightly elevated over the course of the last few months. Demand could definitely push prices up, and tariffs plus labor shortages add to that pressure. Uh, Ultimately, inflation is the fire alarm we don't want going off again, right? That's what the Fed is really looking at. It hasn't fully gone away. Uh, Rate cuts typically can spark a little bit of demand, which could push prices higher, which has been keeping the Fed more cautious recently. On top of that, things like tariffs on small labor force goods could make things more expensive. It's like filling up your grocery cart and you kind of find prices at the checkout keep going up a little bit more, right? And those are things and risks that we need to watch as we kind of go into the latter part of this year and into next year. We really don't want tariffs to turn into toll booths, right? And
Yeah,
that's kind of what's happening is as things kind of come in, we're stopping them and we're increasing the price. Most recently, over the weekend or a couple weekends ago, uh, we had we had another tariff increase on like kitchen cabinets, right? So things like that, you start seeing little things in the economy start increasing prices and definitely adds pressure. So the Fed is trying to juggle cutting interest rates without sparking demand and that demand being sparked on products that have higher prices that ultimately increase inflation. So this waterfall effect is what we're trying to prevent. But nevertheless, right now we're sitting okay, but we have our eyes set on any indicators, and so does the Fed.
absolutely. Yeah, I mean, we've kind of talked about this, but as the economy or the Fed eases, and you know, it's in good shape right now. But as it continues to ease, it's hard to see a time in which we go into a bear market from any kind of or a sustained decline in the market with growth holding and cutting rates. So here's a chart I found that I thought was pretty interesting. So
My
what this
favorite chart.
shows, yeah, this shows S&P 500 total return um, before and after rate cuts after a longer pause. And so get down to the chase of it, I guess, here at the bottom right-hand corner. About 252 days after, you can see that the market averages 15% positive returns in that time frame. The ranges of returns go from all the way -7 to positive 46%. So um, directionally, I like the sound of positive 15% return. That sounds like it'd be in a good spot.
I'd agree, man. Bottom line, even though the jobs market has softened a little bit, the economy itself is pretty solid. It's like a house that has a leak on the roof, but the foundation is perfect. And historically, when the Fed goes from a long pause back into cutting rates, it's a green light, right? It's signaling to everyone that's an equity investor taking on risk, it's time to go. For the outlook to really change up and sour, we would need inflation to break through the ceiling again. Until then, the foundation and structure of the economy right now looks pretty good to be an equity investor to the rest of this year and into next year.
Yep. I think seasonally, as we go into the end of the year, we typically have a nice little uptick going into the end of the year. That's what we've seen historically. So typically September's more of a weaker part of the end of the year from a cyclical basis, and we've had a decent September. So I think the biggest thing that I would add to this is that um, seasonally we should be bullish going into the end of the year. And a confirmation of this would be if small cap here breaks out. So if you look at the chart, the top line here, the top box shows the small cap index since late 2021. And you've seen we've kind of been stuck at this double top formation,
Hmm.
meaning that, large and mid caps have really kind of gone to higher highs and small caps have been kind of stuttered. But if we were to see small caps join, it'd almost be like, you know, someone playing guitar by themselves on the stage to having a full band behind them. So that obviously probably be better for the attendance, I would think.
Yeah, it's I always whenever we look at turmoils, I always look at Florida, right? Seasonally, September is a rough month. We tend to have hurricanes or storms kind of come up, and it's a stormy month, right? And while we get a few showers, the roof hasn't blown off the house just yet. October tends to bring better, clear skies, and I think we're kind of heading for that type of cycle again this year. We'll see small cap joining the rally to James's point. We're seeing a bit of a breakout here in the small cap sector. And we all love music. And I know James is a big fan of live music. And there's nothing better than a lead singer bringing out an entire chorus. And that's exactly what's happening with small caps. They're bringing everybody in to kind of broaden that band out. And ultimately it makes things healthier, it makes the foundation more stable over time, and it really provides a good foundation for growth if everything is growing versus just one specific sector of the market.
Sure.
Yeah.
And to kind of add to this, seasonally speaking, this is a weaker time for crude. And right now we've seen an uptick in rig count. So
Mhm.
with an increased supply and to the market, that could be a pretty good sign for more bullish activity, right? Lessening energy costs could definitely be a bullish sign as well.
Yeah, so oil is like, think of it like seasoning, right, on a dish. We make a meal, it, oil doesn't really make the meal, right? It's not what's going to be the main driver of that meal, but it definitely adds some flavor. It's what's been happening right now in the markets. We've seen seasonally last couple months, it's gotten a little bit weaker. On top of that, OPEC is putting more supply back on the shelves, and the U.S. is dialing up production as well. Uh, Now, something that you may want to take a look at as trades have gotten a little bit negative on oil is it's like everyone betting on the same football team, right? So if you ever watch any type of sport and everybody jumps on that bandwagon, if the underdog even pulls off a little bit of a win, the reaction can be pretty big. So again, this is simply awareness. Oil could surprise with a bounce, but for now, all the bets are on oil continuing to deteriorate and making it cheaper as we go into the end of the year. But just something to take a look at.
Absolutely. And obviously there's Mag 7 risk here on this page. It's just showing quarter year-over-year earnings per share growth. So
Hmm.
is the projected future quarter projected to have higher earnings per share growth than the previous year? And so as you look at this page, you'll see that some interesting things. So some of these projections are actually going down outside of NVIDIA here in first quarter 2026. That red line there looks like some pretty big expectations. But the way I kind of look at this, honestly, is it's still bullish. I mean, we're essentially expecting less quarter over quarter growth from these companies, which I think means that we are anticipating more participation with small caps and mid caps.
Hmm.
And if markets are priced perfectly, then that means that we already see this thing coming. What are your thoughts?
Yeah, I mean, no surprise to anybody who keeps a remote sense of the market that valuations are stretched. They're at historical levels. Leaders in the space, the Mag 7, if you will, have accounted for a lot of the spending and the CapEx spending across the economy. More than anything is that we want to stay cautious. It's the household levels that have loaded up on stock, right? So most families in the US that have any money invested in the market is invested in these couple names, right? I believe it's something like 22 to 25 names comprise almost half the S&P 500 index growth. So definitely something to keep an eye on. Inflation is still a big wild card. Leadership, when it's that narrow, could become a problem. Going back to the oil analogy, if you're everyone's betting on the same team to win, even a little bit of departure from that growth theme could ripple across the board. But right now, we're not really seeing that. What we're seeing is more of the lower performing stocks, the small caps and mid caps kind of coming up and kind of joining this growth model, especially as we go into next year with the Fed cutting rates, ideally into next year.
Yeah.
So where does this put us?
Yeah, so I think we'll kind of show this, and then we'll go to this next slide and kind of wrap things up. But I think some of the bigger areas as far as long-term risk concerns, we've talked about inflation ticking up here. We talked about labor market softening. A couple of things here. This shows on the screen here. This shows U.S. household asset allocation. So as you can see on the top, the median percentage of stocks within a household somewhere around 48%. Right now we're at about 66%.
Mhm.
So meaning the way I kind of think about that is if the market were to have a big pullback, then people would be hit more by that than not. And even though a lot of this money is long-term money, that wealth effect impacts spending. So
Mhm.
when people look at the value of their portfolio or home and they see it going down, they see red, they typically tighten up, and that generates a cycle of slower earnings and slower growth for the economy. So that's one thing that I see on this being a larger risk.
Yeah, I mean, definitely something to keep an eye on whenever you have, again, everyone invested in the same mentality. You also have herd mentality on the opposite side, right? When things start to deteriorate, everyone starts following the trend of it's time to sell. And given the concentration that we have in the economy, heavy or aggressive selling in just a handful of names can be very aggressive across the board and can cause a lot of volatility in your portfolio. So definitely a good opportunity to connect with your financial advisor and make sure your allocations are correctly proportioned to your portfolio and that you understand the risk that you're taking in your portfolio and the potential volatility if the market were to go down or if inflation continues to pick back up. But the main takeaway here is that short-term things look good. Rate cuts and a steady economy have given us the wind at our backs, if you will, to continue to grow into the end of this year, into next year. Risk is 100% inflation, this narrow leadership that we have, households that are all in on equities. It's a lot of different variables that not necessarily to scare anyone, but creating more of an awareness about it. And through our Ned Davis research, we're able to keep a very unbiased view on things and get more of a macro view of the economy to be able to position our portfolios here in-house and for our clients in a way that they understand the risks that are currently navigating in the marketplace, but also could impact their financial plan long term.
Yeah, big picture here. I would say it's important to be diversified. I think the biggest risk I see is folks watching a lot of this no revenue kind of stuff going on with certain stocks, and they get this
Mm,
fear of missing out. So whether your
percent.
fear of missing out is, watching folks that are overly concentrated in certain sectors, or being involved in newer technologies, it all comes down to allocation, position sizing, and having a plan. So um, big picture, we see, bullish to neutral end of the year in the stock market, and we think you should be diversified, have a plan, and make sure you're managing risk. So thanks for watching. Thanks, Manny.
Thanks for your time today.